As of mid-2025, Canada's economic landscape is shifting fast. The headlines may focus on big-picture trends, but the real story is unfolding in the details, in the numbers that shape our daily lives and future prospects. Inflation is back in the spotlight, with the Consumer Price Index jumping to 3.8% in June, up sharply from 3.2% just 2 months earlier. This rapid increase has caught many by surprise, reigniting concerns about the cost of living and the stability of the economy. Earlier optimism, fueled by a brief dip to 1.7% in April, has faded as new global headwinds and persistent supply chain issues drive costs higher. Disruptions in shipping, shortages of key goods, and rising transportation costs are all feeding into the inflationary surge. The Bank of Canada now faces mounting pressure to act, as every uptick in food, shelter, and energy prices is scrutinized by economists and investors. The central bank's next steps could have far-reaching consequences for interest rates, borrowing costs, and the broader financial system. This isn't just about numbers. 3.8% inflation means everyday essentials cost more, squeezing household budgets across the country. Families are feeling the pinch at the grocery store, at the gas pump, and when paying monthly bills, forcing many to rethink spending and saving habits. The next CPI report is critical, likely shaping the bank's next move and the financial well-being of Canadians. Policymakers, businesses, and households alike are watching closely, knowing that a single report could tip the balance between recovery and renewed uncertainty. Understanding these numbers is vital, as inflation erodes purchasing power and complicates financial planning for everyone. Whether you're saving for a home, planning retirement, or just trying to make ends meet, these shifts affect us all. As we dig deeper, it's clear that Canada's inflation story is tightly linked to turbulent international trade relations. Global events, from trade disputes to supply chain bottlenecks, are shaping the numbers behind the headlines and ultimately the choices Canadians face every day. For Canadian families, inflation is personal. Paychecks don't stretch as far, and tough choices are now routine.
We're cutting back on things we thought were necessities. It's stressful. Owning a home feels further away, and saving for retirement is harder than ever.
Imported goods, cars, appliances, electronics, are pricier, especially those with U.S. components. Businesses, especially in manufacturing and retail, face rising costs for materials like steel and aluminum, squeezing profits and limiting job growth. Some absorb the costs, others pass them on, fueling a cycle of higher prices. The unemployment rate has climbed to 7%, with trade-related jobs hit hardest after U.S. tariffs were announced. While some jobs have rebounded, the underlying vulnerability remains, creating anxiety for workers and communities. High inflation and economic uncertainty are now daily realities, making stability and strong leadership more important than ever. Canada's trade relationship with the U.S., once a model of stability, is now under severe strain.
The U.S. imposed a 25% tariff on nearly all Canadian imports, sparing only energy. By June, threats of a 35% tariff and a 50% hike on steel and aluminum escalated the conflict. Key sectors, steel, lumber, electric vehicles, and pharmaceuticals, are all in the crosshairs, threatening Canada's economic future.
Canada responded with targeted tariffs on U.S. goods, but avoided retaliating on the latest steel and aluminum hikes to limit domestic inflation.
The government is walking a tightrope, defending Canadian interests without worsening inflation at home.
All eyes are on the July 21st trade negotiation deadline, a turning point for both economies.
The outcome will decide if we return to stability or slide deeper into a costly trade war.
Trade disputes hit consumers directly. Tariffs are taxes that raise prices on both sides of the border. Even everyday essentials, from groceries to household goods, become more expensive, straining family budgets and making it harder for people to afford what they need.
When tariffs hit, costs ripple through the supply chain, from manufacturers to retailers, and finally to shoppers. Each step adds another layer of expense, as companies pass on higher costs to the next link in the chain, making the final price at the checkout even steeper. The auto sector is a prime example. Parts cross the border multiple times, and tariffs disrupt this flow, driving up costs and prices. This means that even a single car can become significantly more expensive, affecting both buyers and workers in the industry.
Businesses face new administrative burdens, from complex CUSMA rules to costly compliance, especially for smaller firms. Navigating these regulations requires time, money, and expertise, resources that many small businesses simply don't have.
Those unable to meet compliance standards simply absorb the tariffs, squeezing profits and limiting growth. For some, this means cutting back on hiring, delaying expansion, or even facing the risk of closure.
Uncertainty over future tariffs makes companies cautious, delaying investments, seeking pricier suppliers, and building risk premiums into prices. This uncertainty discourages innovation and long-term planning, as businesses struggle to predict what comes next.
This defensive stance leads to inefficiency and higher costs across the economy. Delays, disruptions, and extra expenses become the new normal, making it harder for everyone to get ahead.
The result? Lower productivity and persistent inflation, all fueled by unstable trade policy. Workers may face reduced hours, and companies may struggle to stay competitive in a global market. Without a stable agreement, these inflationary pressures will only intensify, making life more expensive for everyone and threatening the health of the broader economy. The loonie is under pressure. Trade tensions and inflation have pushed the Canadian dollar down to $1.39 USD, from $1.32 just months ago.
A weaker dollar means everything from groceries to online subscriptions costs more, adding to inflation.
The Bank of Canada faces a tough choice: raise interest rates to fight inflation and support the dollar, or risk slowing the economy further.
Higher rates attract investment but make borrowing more expensive, threatening growth.
Bond yields are rising, signaling investor concern and making rate cuts unlikely.
U.S. Treasury yields are up too, showing these challenges are global.
For Canadians, this means pricier imports and higher payments on variable rate loans. The double hit of rising prices and borrowing costs is squeezing households like never before. Policymakers and economists are sounding the alarm. Bank of Canada Governor Tiff Macklem links trade frictions directly to rising inflation and policy challenges.
U.S. Treasury Secretary Janet Yellen urges a quick resolution, warning that tariffs are hurting North American supply chains and fueling inflation on both sides.
Despite the gloom, some experts see resilience. Dr. Tuan Nguyen notes Canadian businesses are adapting, and the risk of a tariff-driven recession has lessened. More companies are complying with CUSMA and seeking new export markets, reducing reliance on the U.S.
The outlook is mixed, danger from trade friction, but also signs of adaptation and strength.
The coming months will reveal whether protectionism or innovation wins out. The stakes are high, and the path forward is uncertain. Canada's ability to adapt will determine its economic future. History warns us, trade wars rarely end well. The 1930s Smoot-Hawley tariff deepened the Great Depression, while 1980s U.S.-Japan disputes raised consumer prices and distorted markets. Canada's own softwood lumber battles with the U.S. have repeatedly driven up costs and created uncertainty for workers and investors. Tariffs may protect some industries short-term, but they often lead to higher inflation, less consumer choice, and retaliatory measures that hurt exporters. Uncertainty discourages investment and disrupts supply chains built over decades. The current broad-based tariffs on steel and autos risk repeating these mistakes on a larger scale. Both Canada and the U.S. face long-term consequences if the dispute continues. The lesson? Trade wars create more losers than winners. Avoiding past errors is crucial for economic stability. For investors, volatility brings both risk and opportunity. The TSX is near record highs, but trade talks could quickly change the outlook.
Defensive sectors like consumer staples are vulnerable, while energy stocks and CUSMA-compliant automakers may fare better.
Rising bond yields make government bonds more attractive, especially U.S. Treasuries, which offer stability if markets turn volatile. Canadian investors must weigh currency risk, as a weaker loonie erodes returns on domestic assets.
Holding some U.S. dollar assets can hedge against further depreciation.
Global investors may see Canadian assets as a bargain if a trade deal is reached. Diversification and a focus on quality are essential in these uncertain times. Understanding how trade policy impacts sectors is key to smart investing. The July 21st trade negotiation deadline is shaping up to be a pivotal moment for Canada's economy, with far-reaching consequences for households, businesses, and policymakers. As the date approaches, anticipation is building across the country, and the stakes could hardly be higher. If negotiators succeed in reaching a deal to roll back tariffs, the Canadian dollar, often called the loonie, could strengthen, making imports cheaper and boosting consumer confidence. This would help ease ongoing supply chain pressures, slow the pace of inflation, and give the Bank of Canada more flexibility to adjust interest rates, potentially supporting economic growth. On the other hand, failure to reach an agreement would mean more tariffs, higher prices for everyday goods, and a greater risk of recession. The Bank of Canada could be forced into a tough policy corner, having to choose between fighting inflation and supporting jobs. Despite these risks, Canadian businesses are showing remarkable adaptability. Over half of exports to the U.S. are now CUSMA compliant, which helps keep effective tariffs low and maintains a degree of stability in cross-border trade. At the same time, companies are diversifying their markets, forging new trade ties in Europe and Asia. This strategy not only reduces dependence on the U.S., but also opens up fresh opportunities for growth and innovation. The most likely scenario is a gradual, uneven return to more normal trade conditions, as mounting costs and economic pressures push both countries to find common ground. However, the path forward will not be smooth or predictable. Inflation is expected to remain elevated through 2025, continuing to affect the cost of living for Canadian families. Still, the ability of businesses and consumers to adapt may help slow the pace of price increases over time. The era of seamless North American trade is likely over. In this new environment, resilience and vigilance are essential for consumers, businesses, and investors alike, as they navigate a more complex and uncertain global economy.